I'm Tom Stelzer from Live Wire Markets, and joining me today is Kevin Hebner from TD Epoch to offer his thoughts on some of the biggest themes in global markets right now. Thanks for joining us, Kevin.
Oh, thank you.
Kevin, I think you've said recently that the US dollar is overvalued by around 15%, with other currencies such as the yen and the yuan undervalued. What do you think the upshot would be if we see a bit of leveling out around that?
So the consequences of a weaker dollar, there's a ton of different consequences for it. But I think it's important first to start off with why the dollar is expensive and why it's a priority of the Trump administration to weaken the currency. Why is the dollar expensive, for example? So the US has an enormous trade deficit. So it's about $1 trillion a year. So that's a pretty big number. And it's deteriorated the last few years. We've had a trade deficit for decades, but it accelerated about 25 years ago with the first China shock. It's reaccelerating now with the second China shock as they double down on exports. And normally, if you have a trade deficit, it's a signal to markets to have the currency weaken so you equilibrate and you get a balanced trade. This time we haven't had an equilibration, and this is what really concerns, for example, Stephen Moran, chairman of Council of Economic Advisors, is because Asian central banks, for example, People's Bank of China, Bank of Japan, Bank of Korea, and so on, have been aggressively buying treasuries, building the dollar up, and at the same time selling their own currency, weakening that and subsidizing exports. So the view of the Trump administration is that the dollar is strong because of the intervention of Asian central banks to subsidize their exports, and that the impact of the strong dollar has resulted in a deindustrialization of the United States. So over the last 25 to 30 years, so much production, manufacturing has been moved abroad. That's created enormous choke points in the US as the US forgets how to make basic things from semiconductors to ships to drones, many of the industries of the future. And that might be okay in a world that's hyper-globalized where everybody's friendly. But in the last 25 years, we've seen the rise of China challenging US hegemony in terms of economic strength, technological capabilities, and defense. So this is no longer tenable, and it's really the core economic purpose of the United States to reindustrialize, and you can't reindustrialize the US without a much weaker currency.
You touched on it there. Yeah. It seems that it is one of the priorities of the Trump administration is to bring the value of the dollar down there. Yeah. What are some of the levers they can pull there, and how do you think they're going to go about this?
One lever would be to cut interest rates. And so in a couple of days, we have the Fed starting a cutting cycle, probably 150 basis points over the next year. So that's pretty conventional. But when you have a structural problem, a cyclical solution like cutting interest rates is not going to do it. And so you need, what they're talking about is a Maro-a-Lago Accord. And over the last 60 years, there's been two other times when the US dollar has been significantly overvalued in creating balance of payments problems. One was 1971. We had the Nixon shock, 15% tariffs, and the dollar weakened by about 20%. The second one was in 1985 with the Plaza Accord under Reagan. Similar impact on the dollar, weakened by about 20%. So you can have an accord, which means an agreement with trading partners to revalue, realign currencies. That's highly unlikely to happen with China. So it'll have to come from unilateral policies of the United States. And so Stephen Moran, the person I was mentioning before, he's currently chair of the Council of Economic Advisors in the White House. And today in the Senate, he's up for confirmation to be a Fed governor as well. And so he's put forward a lot of policies, and among Trump's chief economic advisors, there's broad agreement that these need to happen. But one could be direct currency intervention. A second could be bond swaps. For example, if the People's Bank owns a 10-year or 2-year treasury, swapping that for a 100-year treasury, you could use, and these are things that are suggested by Stephen Moran, a sovereign wealth fund to do it, different types of policies to force a realignment of the currency. And so the Trump administration so far has had a host of policies to encourage reindustrialization. So we've had tariffs, for example, encouraging countries to invest manufacturing facilities in the United States, to open up their markets, to create export opportunities for US countries and so forth. So this is really the second stage of economic policies from the US to encourage reindustrialization, and a weaker dollar is an absolutely core part of that.
Maybe then moving to the Chinese perspective there, what do you think is their express goal and maybe the way that they would potentially go about this? Do you think this is in their best interest as well if we get a devaluing of the dollar?
No, it's definitely not something China wants. China has an unsustainable economic policy right now, modern mercantilism. They've doubled down. The US has $1 trillion trade deficit. China has $1 trillion trade surplus. So it's very much 16th, 17th century economics as practiced in Europe, where you try to export a lot and you accumulate gold. And this as a measure of power. So China is viewing that in particular. They want to dominate the industries of the future. So massive state subsidies to encourage manufacturing investment in batteries, EVs, drones, AVs, all the various industries of the future, semiconductors, AI, and so forth. And they view exporting as a way to encourage their manufacturing capabilities, but they're very much doubling down on exports, even though exports from China to the US are down 20% year to year. Overall, Chinese exports are up 10% year on year to Southeast Asia, still about 7% to Europe, Latin America, and the rest of the world. So this is totally unsustainable. It's going to result in deindustrializing not just the United States, but the rest of the world, Europe, particularly the auto sector. One of my favorite factoids is China this year will export 9 million vehicles. Most of those are passenger cars, 8 million are. 4 years ago, they exported 1 million. That's 9x in 4 years. They're absolutely doubling down on this. This is enormous concern to Germany and France. But as China continues on this path of doubling down on exports as a route to value creation, they're going to be forcing deindustrialization in Europe and Latin America, Southeast Asia. Nobody's going to be happy with that. And there's going to be the same pushback that has been elicited in the last, say, 8 years from the US coming, I think, globally.
It feels like we are maybe on the cusp of a new economic order. What are your thoughts there?
You know, we never get a memo on when the new economic order changed, but the economic order changed 25 years ago when China entered the WTO. And the hope at that time is that China would join the current global economic order, liberal order, that they would trade with everyone and over time become more of a liberal democracy. That's clearly not happening. In fact, President Xi is moving in the opposite direction. The United States, in particular the Trump administration, views China as an existential adversary, and as China's capabilities in manufacturing, economic strength, tech, defense capabilities are challenging US hegemony. This absolutely results in a new global economic order. Trump is responding. And people often view Trump as the person throwing the hand grenades, changing the world order. Trump is responding to the rise in China, this export juggernaut, all these unsustainable policies coming out of China. And I think that was okay previously, say if you had the rise of Japan or Korea or other Asian countries that were much smaller. But given just the size of China and how they're dominating every industry of the future and how aggressive they be. The belief from Beijing of only one-way trade. That is, they want to export, they don't want to import. They want to be independent. They don't want to have any domestic choke points. This is absolutely unsustainable and causing enormous imbalances everywhere. And ultimately, this is what's driving US economic policy.
Maybe just on that point quickly, what do you think the consequences are for some of the developed countries, Australia being a good example, Europe, the developed countries in Asia that are maybe almost caught in the crossfire between the US and China at the moment?
Yeah. You know, a big question on this is why isn't the Trump administration working better with its allies? So Canada, Australia, the UK, a number of countries within Europe, and talking about friendshoring and coordinating policies in terms of economics, tech, and defense. That would clearly make a lot more sense. Trump seems to have a difficult time with that is coordinating well, and I think everyone would be better off. But I think it's important for the liberal democracies ex-US to work closer together. That's something which Prime Minister Carney in Canada has been aggressive about. Ursula von der Leyen, the EC commissioner, and so on. And I think that's important for Australia as well, to coordinate with allies and to some extent present a united front to the United States, because clearly everyone needs to work with the United States. They need to give the US incentives to work with them and not get bullied by the Trump administration. But clearly it's very difficult negotiating with the Trump administration in these areas. And I think that's going to continue to be a challenge for Australia, Canada, and other places, not just over the next 3.5 years of the Trump administration, but beyond this, because when we do get the next administration, they will reverse basically zero of Trump's policies, because the ship has sailed and it's moving. Hopefully the next administration will be friendlier to allies, but it's going to remain challenging.
And finally, staying on the US for a second, the Federal Reserve meet this week, and it feels like one of the biggest meetings in recent memory. What impact do you think this will have on US fiscal policy going forward? And maybe more importantly, what's happening behind the scenes at the Fed right now?
I think market expectation is a 25 basis point cut. And then over the next year, we get 150 basis points of cutting. And that'll be more aggressive than the cutting from any other central bank globally. So it should be a reason for a weaker dollar, because the key short-term driver of currencies is relative interest rates. In terms of other things that are going on with the Fed, so today is Monday, so there's a Senate confirmation hearing for Stephen Moran. As mentioned before, he's chair of the Council of Economic Advisors. So he'll get a seat at the Federal Reserve Board. He'll take on unpaid leave from his White House job, but effectively, he's still part of the White House. So forget any notion of Fed independence from the White House. That gives Trump 3 supporters in terms of Fed governors, 3 out of 7. He needs 1 more. He definitely gets 1 more in May when Powell steps down from their chair position. He'd like to have another, because if you can control a majority of the Fed governors, say 4 out of 7, then you have a lot of impact on the FOMC, the part of the Fed that votes on interest rates, on banking supervision, and even declaring an economic emergency and then using the Fed's balance sheet. So this notion of Fed independence, that is over. It was an experiment that we had, say, from the mid-90s. I think effectively it's over. Maybe not officially until next May, but I think that ship has sailed. And then in terms of how it interacts with fiscal policy, so you very much have fiscal dominance, where fiscal policy will be driving monetary policy, and you will have from the Fed what we'd refer to as financial repression. So Trump wants lower interest rates. Part of that is because the massive payments on the outstanding treasury market, which is now $30 trillion. So fiscal policy is driving this. Trump's economic priorities will be driving the decisions made by the Fed. So I think 150 basis points of rate cuts over the next year is just the start of what the Trump administration wants to be having from the Fed. And we'll be seeing a lot more in terms of using the Fed as a lever for bank supervision. So Trump would like to encourage banks to lend to friends and allies of the administration and discourage lending the other way. And certainly Trump could declare an economic emergency. To some extent, we do have an economic emergency, a $1 trillion trade deficit. This is not sustainable. This is just crazy. The deindustrialization, the imbalances, the income inequality that goes with this is absolutely crazy. So I think the Supreme Court would totally back them on this, that this is an economic emergency, which gives them access to the Fed's balance sheet. It's an enormous balance sheet. Easily, you could get $1 trillion from there to fund different priorities of the administration. So what we're going to be seeing in terms of Fed policies over the next 6 months are going to be very interesting. I think 150 basis points of rate cutting is the least interesting part of it.
Thanks for joining us, Kevin.
Oh, thank you very much.
Thanks for tuning in. Make sure to check out our YouTube channel for more great videos.